Alright, so in this video, I wanted to talk about how I manage my trades, and most of my trades are naked puts or put spreads. So it's mostly going to be a video on how I manage my naked puts and how I manage my put spreads. And I just want to say that I don't think there is one right approach. I really don't think so. In fact, I'm still always improving and changing my approach or strategy. I just wanted to share my approach. Yesterday I made a video talking about the Tasty trade mechanics, or the way that they manage their trades, and I don't even use that way on all my trades. So I just want to share my point of view from my experience. So the best way, I guess, to show it is to give you examples. So here's an example that we can revisit, an example that I talked about in yesterday's video. So this is a put spread that I have on Now, Service Now. So this is a June 18 put spread at 470, 460. Now let's look at the stock let's look at the chart of Now. I guess we could look at the 1 month chart. So first thing, one way to help you manage a trade is to have a good entry. So from the get-go, give yourself a good chance to win. So if I'm selling a put spread, I will usually sell it on a red day. So when I entered this trade here, the stock had dropped from 555 to about 516, and so it was after earnings. So the stock dropped hard. Because it dropped hard, I decided to enter a put spread on this stock, and I went at expected move. So it's already an 80% probability trade because I went at an expected move strike, and because I entered on a down day, I feel like it gives me an extra edge. And I went all the way to July 16. So I gave myself time for the trade to. I see it in two different ways. Sometimes when you have too much time in the trade, it gives time for the trade to do crazy things, but at the same time, it gives time for the trade to recover from its crazy things. So in this case, I just went all the way to July 16 just to give more time, and just so that my short strike is further away. So what happened then is my strike I said was 470. If I go back here in my positions, 470 short strike. So basically that means that I need this stock to stay above 470 by June 18. So if I go back to the chart, you could see that right after earnings, right after I placed this trade, the stock kept dropping and dropping and went to 480, 490. And then at some point it was completely breached. It went to 450 as well. So my strategy, or my way of managing in this case, it used to be by selling a call spread, by selling the opposite side. By selling the opposite side, I'm collecting extra credit, and I know that I can't lose on both sides. If I sell a call spread at 500, 510, I can't lose on both the put spread and the call spread. I'm either going to lose on the call spread because the stock went above 500, or I'm going to lose on the put spread because the stock went below 470. The stock can't be at two places at the same time. So that's one mechanical way of managing a put spread that gets tested or breached. I used to do that, but from experience, I realized that every time I do that, or maybe 80 or 90% of the time that I do that, the call side gets breached later on. So I decided to change it up a bit, and just to try to save the put spread instead. So whenever a put spread gets breached, instead of selling the call spread against it to mitigate the max loss, I will roll the put spread. Now, once a put spread is breached, it's hard to roll it as is for a credit. So if I'm going to roll it forward, I'm going to have to add contracts or increase the width of the spread in order to roll for a credit. Now that's risky because I'm adding more risk to the trade. If my initial put spread was 10 point wide and I roll it by increasing the contract, then I'm adding an extra 10 point to the risk on the trade. So my max loss has increased. But I'll only do that if I can bring my strikes lower, and if I think, or if I feel that the stock will recover eventually. So right now, because the trade had time, it has a July 16 expiry. When it was trading at around 450, I did nothing. I just held on to it because I know there's still time, and I'm gonna decide in the last 1 or 2 weeks what to do. And luckily the stock has gone up above my short strike of 470. It's trading at 485, but it's still not closable, but I'm gonna have to hold on and wait and see what happens. And if I just look at the chart quickly, I mean, it's not nothing guaranteed, but just looking at the chart, it looks like it's a chart, it's an uptrending chart. And then it took a big drop and then it came back up again. Now it dropped again. So I just think that just by looking at the chart, I feel like it will eventually recover. PE ratio is kind of high, so it could suggest that the stock wants to drop a little bit to get closer to a decent valuation. But I try not to overthink it. And I'd rather just, from experience, try to save the put spread by rolling it if I have to. But I'll usually roll in the last 2 weeks. So for now, this one I'm keeping. So let's look at another example. I've got a Teladoc here that I opened. The entry wasn't great. So starting off, the entry on this one was not great. It's a 150, 145 put spread for June 18. So this one has 23 days to go. But this one is completely breached. If we go look at the Teladoc chart, so let's look at 1 month. So most likely I opened it when it dropped, but sadly it continued to drop even more. So I probably opened it around here, but then it dropped even more, and then it even dropped all the way to 132. Now, what I could have done at this point is I could have sold another put spread, making a completely new trade at when the stock was trading 130, my short strike probably would have been 110, 105, and that new put spread would have been an easy winner, and it would have helped me mitigate this potential losing trade. But as you could see, even with the stock at 130, my put spread is at 150, 145, so I need the stock to be trading above 150 by June 18. I didn't do anything because I have time on the trade. I left it. I didn't sell a call spread. Now imagine if I sold the call spread and then the stock comes back up and then breaches the call side, which usually happens to me whenever I do that. So I did nothing. From experience, I learned not to do anything. Sometimes it's better not to overmanage. And as you can see now, the stock is back up to 148. It had a high today of 150. So hopefully, if I give it a few more weeks, maybe this trade becomes a winner. So that's another way of managing a put spread. Sometimes just don't do anything and just let the probabilities play out. And as long as you give yourself a good edge in the entry, then you should trust the probabilities. So here's another put spread. This one's pretty bad. So this is an Etsy put spread at 180, 175, June 18 expiry. This one I believe I entered before earnings, and then the stock dropped hard after earnings, and I rolled it quickly. Actually, I rolled it before earnings. I rolled it before earnings for this at the same strikes, keeping the same strikes. Collected an extra credit because it wasn't breached yet. But sadly, after earnings, the stock dropped hard. So this is a 180, 175 put spread. So now if I look at Etsy, I think it's trading in the 160s. So if we look at the chart, yeah, Etsy's trading at 168. So I need it to be above 180 by June 18. So that's a problem right now. So if that doesn't happen, what I'm gonna have to do, so either I sell a call spread against it. So let's look at what happens if I sell a call spread. So I can click on Etsy here, click create order, and then change it into a call spread. And let's say I turn the trade into an iron butterfly. So if I sell a call spread where the short strikes of the call and the put are the same. So the 180 short strike of the call is the same as the 180 short strike of the put. So in this case, I'm selling a call spread, but I'm turning the trade into an iron butterfly. You can see that I could collect $1. So if I collected, let's say $1.20 from this put spread, and I collect another $1 from this call spread, I now have a total of $2.25 collected from an iron butterfly that is 5-point wide. So my max loss on the trade now would be 5 minus $2.25. So my max loss would be $2.75. If I have one contract, so that's $275. My max loss would happen if the stock is either trading below 175 or is trading above 185. But now by selling the call spread, I've just added an extra restriction to the trade. And if Etsy rallies by June 18 and breaks my 185 strike, then I've just confirmed the loss. So what I'm going to do is I'm just going to hold on to it and wait in the last week. If Etsy is still trading below 175, I'm going to try to roll it as a put spread. It's going to be hard to roll as a put spread if it's breached. I'll have to definitely increase the contract. So what I'm going to have to do, I'll give you an example here. So if I try to roll it right now as is, so let's say I go from June to July 16. Okay, so I'm going to sell. Let's say I want to roll it as is, same contract, same width of the spread. So 180 and same strikes as well. So July 16, and I'm selling 180, 175 put spread. So if I roll it as is, you could see that I cannot do it for a credit. I will have to do it for a debit. If I roll right now from June 18 to July 16, same strikes, same width of the spread. So if I don't want that, what I'm gonna have to do is either bring my strikes higher, so maybe go to 185 on the short strike and then 180 on the long strike. But this means that I feel that the stock is gonna go up, but I just need to give it more time. And I still cannot do it for a credit, so I might have to go higher, or I might have to go further out in time. So let's say I go to December. Let's say I go all the way to December. I want to forget about it. I want to just hope that in December it comes back up. As you can see, I'll still have to roll for a debit. So maybe if I increase it, go higher, I go from 190, so from 190 to 185. So now I have a new put spread at 190, 185, and I still can't do it for a credit. It's going to be for a debit. But now watch if I increase the contract. So if I do 2 contracts instead of 1 contract. So I can actually, let's start off with the same strikes. So 180, same strike that I have right now. So 180, 175, and I add 2 contracts. So you can see that I can actually do it for a credit of about $2.50 about $2. But obviously it's because I'm adding an extra contract. But that means I'm also adding more risk to the trade. So now I'm collecting an extra $2. So now we'll have collected a total of $3.50, let's say. But now I've got $7 or $6.50 of risk. But I've got a new trade where as long as Etsy's above 180 by December, I win on this trade. So I'm giving myself more time if I feel like the stock just needs more time to recover. Another thing I could do is, since I've added a contract, I can bring my strikes lower. So I can try to go to 170, 165. And can I still do it for a credit? Yes, I can still do it for a credit. I can collect $1.50 by adding a contract and bringing my strikes lower. So now I'm making the trade a bit safer because I'm bringing my short strike lower and I'm giving myself more time as well. And I can still bring my strikes lower. I can go to 160, 155. So yes, my short strike is safer, and yes, I'm giving myself more time, but I'm also adding more risk to the trade. So you have to realize that. But if you're confident that the stock just needs more time to recover, that's one way of managing. That is something that I will do. Sometimes instead of adding a contract, I'll just make the spread wider. It's the same thing. So as you can see, I could do this for a credit. I could still roll for a credit. So I can actually go even lower. So let's go even lower. Let's go to 140, 135. I just want to make the trade super safe. So you could see right now, I would have to do it for a debit. So let's go back up. So let's go to maybe 150 and 145. Can I still get a credit? Yeah, so I could roll it this way and I could still get a credit. It'll be a very small credit. But now I have a much safer trade, 150, 145 all the way to December. So that's one way of managing this trade. Another way of managing this trade is turning it into a naked put. So if you have the buying power, if I have the buying power for a trade, for a naked put, I will turn this into a naked put. So for example, assuming I have the power, Etsy is not something that I would hold naked because the margin requirement on Etsy is 50% with Questrade. So it's going to take a lot of maintenance excess out of me. So I would not turn it into a naked put, but just for example purposes, another way I would manage this is by June 18, you could see that the stock needs to be above 180. It's at 168. So one way to manage it is to close it and sell a naked put instead. I could choose the same strike. So I can manage it earlier or I can manage it on the last week. Usually if I do this at the last week. So it's really last resort. But let's say I wanted to do it earlier and then I sell, let's say the stock's at 168. So let's say I sell the 165. Can I do it for a credit? So yeah, you could see that I can close my existing put spread right now and sell a naked 165 put for June 18. So the 165 is out of the money. It's below 168. And I can do it for a credit. So I can actually go even lower. Let's try the 160 put. For 160, I can do it for a credit. So yeah, a very small credit. So that would be one way of managing this put spread, is turning it into a naked put, obviously picking a strike that's lower than the current market price. So now I only have to wait to June 18. As long as it stays above 160, then I win on. I've saved this trade. I've added more capital, of course, because I turned it into a naked put, but I've saved this put spread. I can also go to a different expiry, so I can go to July 16, and if I do that, I'll collect even more credit, so I can even bring my short strike lower. So now by turning it into a naked put, I can go to the 150 put for July 16 and collect maybe 50 cents. So now I'm saving this put spread, and all that is required for me to win on this trade is for Etsy to stay above 150 by July 16. So that's another way that I would roll a put spread or save a put spread. And I actually do this often, but obviously with small price stocks. So I did it with AI. It was initially a put spread at 75.70, I think. It was actually a put spread at 75.65, and I turned it. Actually, let's look at executed AI. Yeah, so it was a put spread at 65.55, and I turned it into a naked 60 put for July 16, collected a credit, of course, and yeah, so that's the trade I have there. I did it as well with, I think that's it, yeah. So here's another example. So how would I so I showed you how to manage a put spread that gets breached. I've showed you some examples. Here's another example, Beyond Meat. This was an earnings trade that went against me. It was a 115.110 for May 21st, I believe. And I ended up, actually, let's look at orders executed. Beyond Meat, BYND. So yeah, it was a May 7th, was it? Yeah, okay. So it was a May 7th put spread at a 115.110. It got breached after earnings. So I got lucky. The stock was trading right after earnings. It was trading at around 114. So I didn't take any chances. I rolled it right away. Same strikes, so I kept the same strikes, but I went to June 18, so I was able to collect an extra 8 cents of credit. So that's why I'm left with the June 18 Beyond Meat 115.110 put spread. And if we look at the chart for Beyond Meat, I just held on to it. So what happened is I rolled it as is. I didn't try to sell a call spread. I just rolled it as is and gave myself more time on the trade. And luckily, the stock has recovered. It is at 130, and I think I can even close the put spread for a small profit if I want to, but I'm gonna hold on to it a little bit longer for more profit. And yeah, so just by giving myself more time on the trade, I was able to turn it into a winner because the stock has recovered. Now, it doesn't mean that it's not gonna drop, but it looks like it's gonna be fine. And let's go see what I can close it for. Yeah, see, I can close it for about 75 cents. I collected about $1.08. So I'm not going to close it because of commissions, but I'm just showing you that by giving yourself more time on the trade, instead of accepting the loss, instead of selling a call spread against it, you can save a put spread. So let's look at a naked put now, an example of a naked put. So this one's Spotify here. This one's pretty bad. So Spotify was a naked put. I played for earnings. The stock was trading at 290, as you can see on this chart here. I sold a 260 put for $1, the same week expiry. I'm 30 points away. I'm thinking this is super safe. I'm gonna win. Stock ended up dropping below 260, so I rolled it. So when I roll a naked put, I am basically just buying back the first put that I sold, and I'm selling a new put at a new expiry. It could be the same strike, it could be a lower strike, but as long as I'm rolling for a credit, then I'll roll it. And I'm basically same thing. I'm giving the trade more time. I'm giving the stock more time to recover, and I'm collecting a credit as I'm rolling. So if I show you the Spotify trades, I hope it shows on this here. It's been 1 month, yeah. So yeah, I sold the April 30th Spotify 260 put for $1.10, and then Spotify dropped below 260, so I had to roll it. So I rolled it. So this second line here is me rolling it. I had to buy back the 260 put, and I sold the 257.5 put for May 7th, and I was able to do it for another credit of $1.10. So now my break even is 257.5 minus the $2.10 that I collected. So let's say at 250. So my break even is about 255 now. But then Spotify kept dropping even more. So I had to roll it again. So I went from May 7th, and this time I had to go further because Spotify dropped so much. So I went from May 7th to July 16 expiry, and I went from 257.5 strike to 250 strike to make the trade safer. I collected $2 to roll this. So now I've collected a total of $4.20 of credit. So now my break even is 250 minus the $4.20 of credit. So my break even is about 245. So now I'm just waiting for Spotify to recover. And luckily you can see Spotify is trading right now at 238. At some point it was at 215. So yeah, right around here it was trading at around 215. And yeah, now it's starting to gradually climb back up. And all I need right now is for Spotify to be above 250 by July 16, and this trade will be a winner. So that's how I manage naked puts, is I roll them instead of confirming the loss. Now, once again, I don't know if that's the correct approach. Maybe it's better to just accept the loss and maybe sell a new put much lower instead of just trying to save it. So I'm not sure what the right approach is. I'm just sharing what I do and what has worked for me as well. I could also sell a call against it, but I'm afraid that if I sell a call, the stock comes back up and then breaches the call. So same idea, same concept of the call spread. Especially if I sell a naked call, then there's no protection, there's no cap on the loss. And the reason I felt comfortable rolling Spotify is because I really feel it was completely oversold. I mean, it was trading at around 380 at some point. 52-week high is 387. The stock dropped really hard, so I really think it's going to come back up. So that's my assumption on the stock, and that's what makes me comfortable rolling it. And also, before entering any trade, I make sure that if it's a losing trade, if my short put gets breached, can I afford rolling it? Can I afford saving it? If it's something I can do, then I'll place the trade. Otherwise, I won't do the trade. And that's why you'll see me very hesitant often, and then I regret not placing the trade because it would have been a winner. But sometimes I'm hesitant because I don't feel like I can afford saving the trade if it gets breached. I always have to have an exit plan in case the trade goes against me. Same thing with pins. I had a naked put, got completely breached. I just ended up rolling it. So if we want to look at an example at pins here, so this was for earnings as well. So I started off with a 170 put, it got breached, but I collected $1.17. So I ended up rolling it from 70 to 68. I brought the short strike lower, and I went from April 30th to May 21st. I collected an extra 30 cents. And then May 21st, the 68 was still breached, so I had to roll it again. This time I went from 68 to 67.5 from May 21st to July 16, but I collected $1.68. So now my break even is 67.5 minus all the credits that I received here. So that's my break even. If Pinterest is at my break even price by July 16, I don't lose any money. If it's above 67.5, then the trade is a winner and it's profitable. And right now, Pinterest is trading at around 63. So it's getting close to my short strike. So yeah. So sometimes rolling it is good because you end up saving the trade and not confirming the loss. So yeah, so that's how I manage my put spreads and my naked puts. As you can see, I don't look at necessarily at 21 days. If there's 21 days remaining in the trade, I usually try to take action in the last 2 weeks, just because I don't want to get assigned. If a short put is deep in the money, there's risk of assignment. So I'll take action just to avoid assignment, but I don't necessarily care if I hold the trade past 21 days. But I'll usually roll it if there's no more extrinsic value left in the put option. That's what I usually look at. So yeah, if you have any questions, if you want to share your management style, leave in the comment section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. Also check out the other referral links below. It might interest you. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.